afternoon, everyone. I am Snisha Dwaru and I belong to PMB Case Study Group 8. And today we will be presenting our financial analysis on the launch of Crest White Strips. Before we begin, allow me to highlight the layout to expect going forward. We start with the outline of the base NPV and profit and loss, and then move on to the accounting and present value break-even. We will then proceed to look at various scenario analyses and answer Angela's questions, and we will take a very brief look at areas to accelerate the growth of product and risk factors in launching this project. An exchange rate of 14 Rand 33 to the dollar was used to convert monetary values from dollars to rands. The base NPV. As presented on the left, we have a table demonstrating the cash flows calculated from years 0 to 4. All values in the table are in dollars, and it was assumed that the market budget for launch was to be combined with the annual advertising budget of $6 million, and depreciation was assumed to be straight line. The total cash flows were then calculated and used in the calculation of the NPV, along with the discount rate of 4.5%. The NPV was then converted using the foreign approach to arrive at a positive NPV of 777 million Rand, implying that the project is financially viable.
Hi everyone, I'm Mobile and I'll be talking briefly about the profit and loss part. So as we can see, the company expects to receive profits for all the 4 years that we accounted for. The first year it's going to be 132 million, second year, third year, and the fourth year it's going to be the same amount of 123 million. Looking at the tax profit margin, these are acceptable and reasonable percentages according to the norm of tax profit margin. The first year it's going to be 19.53%, second year 18.33%, third year 17.56%, and the fourth year it's going to be 16.86%. In overall, the profit and loss part shows that the company expects to make profits from this product.
Good day, everyone. My name is Nomfundo Mkhize, and I'll be speaking about the break-even. So we calculated the accounting break-even, and it amounted to 305,000 units. We also calculated the present value break-even, and it amounted to 281,219 units. The difference between these two units arises because the present value break-even, unlike the accounting break-even, considers the initial investment by annualizing it to get the equivalent annual cost, which is then used in the present value break-even calculation.
Good day, everyone. I am Kazimulo Zitsaga, and I'll be discussing the various scenarios which we analyze in order to determine whether the project is actually viable. So I'll be discussing the first two. The first one is higher trial premium cannibalization scenario. So all figures are in dollars, and the NPV which we worked out at a cost per unit, at a selling price per unit of $18 is NPV of negative $29 million. So when converted to rands using the exchange rate of 14 Rand 33 cents per dollar, the NPV worked out to negative 420 million Rand. So this NPV is negative, so the project is not viable. So the second scenario, it's higher trial for the base product. For this one, the selling price per unit is $15. All figures are in dollars, as I explained. The NPV worked out to negative $14.25 million. When converted to rands, the NPV is negative 204 million rands. The NPV is also negative, which means this scenario is also not profitable for the business, so it's not viable.
Hey everyone, my name is Nusi Kozamini, and I'll be going through the next two scenarios. I'll be going through the lower trial premium product. In the lower trial, the sales volume decreased by 1 million units, and there was also a decrease in annual sales to $5 million. And we got a negative NPV of 391 million. In the next scenario there was a volume increase In year one, there was an increase of 150 units, and there was also an increase of 50,000 units. And the sales amounted to 2,150,000 for year one and 12,050,000 for year two. And we got a positive NPV of 995 million.
Good day, everyone. My name is Nondumiso Kumalo, and I'll be taking you through the two following NPV scenarios, which indicates the different options with the new technology the company plans to use. So with this scenario, here there is a $1 increase from the original price of 22 Rand, and the cost of goods sold increased by $2. Bear in mind, implementing the new technology. The NPV here is 1.425 billion. This is a positive NPV. This is a positive NPV. The second scenario indicates a $2 price increase. The cost of goods here also increased by $2, and the NPV is 1.283 billion, which is positive and acceptable.
The next question is answering. The next section is answering Angela's question, and I'm going to answer the question that says, does this pay out for our business? And the answer is yes, since option 5 has a positive NPV of 1.425 billion, and we're gonna accept this project using option number 5.
The next question asked by Angela is, are we better off launching the product? And the answer is yes. That is because our sales exceed our cost of sales and other expenses for all the foils that we accounted for, and the company expects to make profits. Looking at the profit and loss part, we've seen that the company will be making profits for all the foils that we accounted for. Moving to the NPV, we've seen that, as stated above, that the first three scenarios have negative NPV, so we won't go with those scenarios because they will cost the company. The best option for the company is the scenario number 5, which has the highest NPV from all the other scenarios.
In answering question 3, what are the risks? So the biggest risk is the cannibalization effect, which means that whenever we sell the new product and we receive higher sales, there's a likelihood that most of the customers come from some of our other products. So overall, the business might not be making a significant profit, but the new product might have higher sales. So that is the highest risk. So the second risk is the risk of the market not accepting the product. So this means that new products generally fail in the first year of launch, and you end up having high costs in the beginning, which might affect generally the business as a whole.
What do we need to think about when designing this product? The reason for initiating the new improved product was that customers were not satisfied as the strips fell off. The new product would have to be more advanced and adhesive. Research needs to be done to make sure that the new product will satisfy all the customers' needs. So when designing the improved product, we need to be thinking about the improved technology that has to be used.
Some of the areas to accelerate growth of product includes increasing the household penetration. This can be done by making advertisements more memorable, as well as creating an informative product description, just to name a few.
As we all know that there are certain risk factors that companies need to consider before launching their products internationally. The same applies with P&G. P&G needs to consider risks such as foreign exchange risks. These include translation and transaction risks. They also need to consider political risks such as civil wars and regulatory changes. This brings us to the end of our presentation, and I'd like to highlight that P&G should launch their product in the US. Thank you for your time.